No, the dollar index correlation, for example, to gold is very pathetic. It's not good. If you take, for example, when gold bottomed in 2015 at 1,050, the dollar index was where? Around 98. Okay. Since then, the dollar index has been both above and below that level. Now it's trading, right, let's call it at that level. Where's gold? 4 times the price. So if you use the dollar index as your reason to buy or not buy gold, you miss the move. Okay. So, but the dollar index broke annual momentum measured by a couple of our long-term metrics back in April when it came down to 104.20. Okay. We said sell. It plummeted into April, just like the stock market did, by the way. Keep that correlation in mind. January through April, May, and so forth, just like the stock market. And when the stock market rallied, what did the dollar quit doing? Going down. It tried to rally, but it's basically been spinning its wheels all year long, either side of, let's say, 99. So it's really not had any action, and yet it's broken. Just like gold drop versus the S&P, during the 2000, especially starting in 2008, and then especially as gold started to collapse in 2012, 13, 14, 15, XAU collapsed off the page. The gold miners in general, gold and silver miners in general, if you use GDX or XAU, collapsed to effectively zero. I mean, it went, let me put it this way. If you measured XAU back in the 80s, the 90s, 2000 into about 2008, there was a range of performance readings where plot monthly close, XAU divided into an ounce of gold, where it was living in a range from 17.5% of that ounce of gold, XAU, to 30+%. It's living in this like 15% range, up and down, up and down. That was its reality of performance. When the collapse came, it went to 4%. I mean, if that were a price chart, you'd say, hey, is it going to go to zero? Well, of course it can't. They produce the stuff, okay? Since then, you've gone from that 4% low with a couple highs up above 8%. And right now you're in the 7% area, okay? You ever get XAU out above that 8% again, divide XAU into an ounce of gold. And we've had strength in XAU, since about April, May. They surged more than gold did. Now, recently they've had violence, but they're out above the 2011 high finally. Okay. That spread is firm, but it's not a breakout. You get above that 8% level one more time, you're going to break out of a decade-wide base with the gold and silver miners, because XAU includes both, where there's nothing between you and that 8% level and 17.5%. You look at that spread chart and treat it as a price chart, and you'd say, hey, this guy breaks out, it's open field running. Before you even bump anything, it might be, in other words, you could double and a half the miners versus gold over the next year or so.
With gold performing well. Just
gold performing well, them beating the pants off gold. So my preference is silver, gold, silver miners, then gold, that order.
The XAU to gold spread has pushed upward several times in recent years, briefly touching above 8%, the threshold analysts view as a decade-long breakout point. Surpassing that level would complete a massive base pattern stretching back to 2011. If miners clear it again, historical models suggest a vacuum zone with little overhead resistance until 17%. That implies miners could outperform gold by more than 150% during the next bullish phase. Recent price action supports this. In 2024-2025, leading miner ETFs surged more than 100%, while the S&P 500 rose modestly. Yet the breakout still hasn't happened, making the setup even more compelling.
It's slightly lagged to the gold S&P spread, but it's not far. It wouldn't take a lot for it to produce a breakout month as well.
Yeah, and you can see just in price performance this year, you've got the miners indexes up 100, 120% versus 10, 15% for the S&P. And we have yet to break out, which is the intriguing piece.
Of the spread. Yeah, you're quite right. And when that makes a statement, that's another table pounder, because it says, hey, if you don't want to buy gold, you don't want to buy silver futures, you don't want to buy silver bullion ETFs, you got miners, they have earnings, get checks or dividends. Newmont pays pretty good, I think, and it went from $30-40 to all of a sudden, bang, 90. Mm-hmm. Didn't shock us because momentum said it was likely to explode. But that's the kind of behavior. What if they're undervalued still? Which they are. relative to gold and relative to the S&P. If they break out of those spreads, wow. We measure the 30-year T-bond futures. They've been around since I got in the future side of the business in 75. I think they started in 76 or something. Anyway, they measure 30-year bonds, and they're not affected greatly by Fed policy. Fed policy affects short end. In fact, when they had a rate cut, past rate cuts a year or so ago in September and then recently, T-bonds yields went up. Okay. Yeah. And when you look at the price chart of T-bonds, they dropped from a 190 level in 2020 down to 117, and like you said, in 2022. You could draw a line sideways on price, meaning high on yields. And we've been laying either side of that line for 3 years now. No recovery. There have been 3 efforts to recover, and each one of them has been a dud, meaning to drop yields or rise price. Right now, we're trading around 116. You ever get down to 111 and a half, put your helmet on. That recent lows this year have been just above 110, but you get to 111 and a half, expect a downside panic, the kind that would garner headlines.
While miners fight for a breakout, the long-term bond market signals mounting stress. 30-year Treasury futures have fallen from 190 in 2020 to near 116, erasing 4 decades of accumulated gains. Each attempted recovery has failed, keeping yields elevated despite periodic rate cuts. Analysts warn that if futures fall toward the 111 to 110 level, panic selling could erupt. Rising corporate refinancing costs, especially in commercial real estate, magnify the risk. With debt loads at historic highs and global liquidity thinning, another leg down in bonds could force emergency interventions, testing confidence in government markets once considered untouchable.
I don't have that, except to say that because of the debt crisis situation that many companies are in right now, particularly commercial real estate, but others as well, crises helped sparked by the Bitcoin collapse or the stock market implosion, doubt on the part of investors, unemployment, all these things will cause government to have to print and therefore further degrade the real value of their bonds. So it's a competing degradation. So the fact that the dollar index upticks a bit, really it's gone nowhere since the April crash. Dollar index dropped from, we sold it at 104 something, it dropped into the mid 90s. Right now it's around 100. It's in comatose. So it's all competitive degradation. And the question is, I don't know what the outcome's going to be. Because frankly, when you get into that kind of crisis and doubt exists for Japanese, UK, maybe European, but certainly ours as well, where do you go? I don't know. The dollar index correlation, for example, to gold is very pathetic. It's not good. If you take, for example, when gold bottomed in 2015 at 1,050, the dollar index was where? Around 98. Okay. Since then, the dollar index has been both above and below that level. Now it's trading right, let's call it at that level. Where's gold? 4 times the price. So if you use the dollar index as your reason to buy or not buy gold, you miss the move. Okay. So, but the dollar index broke annual momentum measured by a couple of our long-term metrics back in April when it came down to 104.20. Okay. We said sell. It plummeted into April, just like the stock market did, by the way. Keep that correlation in mind. January through April, May, and so forth, just like the stock market. And when the stock market rallied, what did the dollar quit doing? Going down. It tried to rally, but it's basically been spinning its wheels all year long, either side of, let's say, 99. So it's really not had any action, and yet it's broken.
The U.S. dollar index has drifted sideways since its sharp drop in early 2024, oscillating near 100. But the index itself may no longer accurately reflect global currency dynamics. 70% of it is made up of just the euro and the yen, both struggling with their own structural issues. Historically, gold has risen regardless of the dollar's direction. When gold bottomed in 2015 near $1,050, the dollar index sat near 98, almost the same level as today, yet gold is now 4 times higher. What matters more is money supply and purchasing power, both eroding rapidly. Inflation, not FX positioning, is driving the long-term trend.
We think probably it's going to break more and go down and even challenge the lows at 70 that occurred decades ago. But I almost don't know whether that's relevant. Because again, we're dealing with competing against what? Well, heck, you take the euro and the yen, they constitute 70% of the dollar index. Is that really an index? Like is NASDAQ 100 an index with 4 or 5 stocks constituting 50? You get my point. Mm-hmm. So I'm not sure what the dollar, quote, index value means. I'd rather look at M2 and what the real buying power of the dollar is. And it sucks, okay? When your granddad built a house that cost $4,500. When your dad built one, it was $45,000. Median home price now is $450,000.
But we're all wealthier, right?
Yeah, we're getting rich, right? No, it's meaningless.
After dominating the post-2009 bull market, major tech names are flashing early signs of fatigue. Credit conditions are tightening, delinquencies are rising, and even giants tied to consumer spending, like Visa and MasterCard, now breach long-term momentum floors. Financial weakness often precedes broader equity trouble. Meanwhile, global markets remember that the Nasdaq took 16 years to recover its 2000 highs in nominal terms, and much longer in real dollars. With AI valuations stretched and economic cracks widening, experts warn that the next major downturn may not resemble the shallow pullbacks of recent years, but something far more consequential.
They are, and they've doubled what the S&P did since 2009, so they're definitely the leaders. This was true at the dot-com high. And what happened from 2000 to 2002? S&P had 50% drop, NASDAQ 100 dropped 82%. And by the way, it took NASDAQ 100 until the year 2016 to even get back to the nominal price high it saw in 2000. In real dollar terms, it probably took till 2020 to get back to the real dollar. Okay, you get my point. Mm-hmm. So yeah, ultimately AI will be weaker, or tech will be weaker than the broad market. Whether it is right now is not a big issue. It's just sort of catching up. Okay. There's other factors, other indexes within the market that are too important to ignore. Financials, we even picked out Visa and MasterCard. We know the credit card debt is a problem right now and delinquencies. And sure enough, their charts are breaking through massive quarterly momentum floors going back several years. You don't see it on the price chart. Bitcoin's joining in. Suddenly, financial repercussions there. So I'm not sure about the Forex issue, but the one I'm watching right now that is huge because it's bigger than the stock market is T-bonds. You can't afford those guys to go from lame to another downside break. Even if the Fed comes in with fire hoses, you can't afford to even have that break begin because confidence will go out the window. And then there's the one alternative.
Bitcoin, representing more than half of the total crypto market, is now forming a dangerous momentum pattern similar to the S&P 500 structure before its 1987 crash. Despite making new price highs in 2024, each rally leg has weakened. Key momentum floors around $101 and $108K have already broken. If Bitcoin drops to 74, analysts expect a rapid slide toward 60 cal, where panic could trigger forced liquidations across the digital asset sector. Even recent equity market rebounds have failed to lift crypto. Should Bitcoin unwind sharply, it could amplify stress across credit markets, tech stocks, and risk assets globally.
You can look at a Bitcoin chart, and remember, it's 57% of the crypto market. So you can look at Ethereum all you want to, and recently when it made that new high, which was a bull trap, excuse me, it was a trap. And it's only like 17% of the crypto market. So we're focused on Bitcoin. As it goes, crypto will go. Okay, forget everything else. When you look at a Bitcoin chart, you've had this layered, surging bull market. We got bullish in 2023 when it was in the 20,000s. Okay. But since then, you've had this wave after wave in price. But if you'll look at the price chart even, you'll notice that the waves since 2024 have gotten a little more anemic each time. Yeah, it's a new high, but it doesn't surge quite the same strength, and it doesn't go quite the same distance that the prior one did. So even on the price chart, you can see some languishing. But when you plot momentum, you've got a structure from hell. And it's the exact same momentum structure that the S&P 500 had in 1987 before its crash. You had a multi-year floor where the S&P in its rise kept touching back down to its rising three-quarter average, using that as a floor. On the momentum chart, it was a flat floor. When you broke that in early October to 87, and I caught that crash, I was a futures broker, not in a big way, but I caught it with puts. Like in a week or so, it crashed 30-something percent. That's a crash, dimension 30% in a couple weeks. Right now, we've not done that in Bitcoin yet. Heck, maybe the next week or two we might. But it blew the floor at 101,390, and we had another floor broken at 108,000, by the way, on a different metric, 100-week momentum. We argued that when you break that floor, you might not want to wait to the end of the month close to be sure it was a monthly closing breakage, because sometimes in the middle of the month you might go to hell, like it did in 87. And it looks like we're doing that. And even when the S&P had these sharp rallies intra-week, you see Bitcoin, it can't get up off the pavement. It stops, but it doesn't really rally. And you can overlay a NASDAQ 100 monthly price chart on top of a Bitcoin price chart and go back to 2020, do that on your screen, and you'll notice, they're overlays. In fact, we did this a few months ago and took the price scale off of both so you wouldn't know which is which, and you couldn't tell the difference. Now suddenly, Bitcoin made a new high, 7 weeks ago, 127.
October 5th.
Yeah, roughly. You got it. Okay. And now you're 20, 27, 30, whatever. You've basically collapsed. And only now, maybe NDX is going to play the same game. I suspect the real damage in the stock market's going to show up next year, not this year, because there's some annual momentum reasons for that. But Bitcoin is broken, and it hasn't even hit, quote, the stops as far as I'm concerned. I think those are around 74,000. You hit that, I think you could be at 60,000 in a heartbeat. And that's where I would say, yeah, you might bounce here. Don't get long.